In fact, the lecture that you all are following today is a recording simply because I would not be available on usual Saturday afternoon class on 15th. So you will get this recording to follow up our discussion on the topic that we started last week. That's mainly on structure and competition of the financial intermediation, particularly the banking sector. That's what we are looking at. So we will continue the discussion, and you will be able to follow through in terms of the handout you already have with you, and also from the perspective of further clarification. You can raise any areas of concerns when we meet for the next class, most likely on the following week. So you are seeing here the structure and competition, where we broadly discussed the importance of how these banks evolve across the period, starting from the early days, and how it has moved into the context that you probably be now familiar with. And we talked about the banking, beginning of banking in England, and we broadly kind of looked at how in the earlier days and subsequently towards more recent times, including the 1960, not 19, it's 1694, Bank of England's establishment, and then subsequently how it expanded to facilitate including issuance of currencies, banknotes, in a very simple sense, effective 1833. Okay, and they have made it the legal tender with UK's government authorization. So you see the evolution of banking sector in UK during this period. But then, of course, we are getting into US. The gradual expansion of banking institutions into today's context has evolved across the Europe, and then to Americas. And you probably see in the Americas case, it's in North America. And you see when it comes to US banking sector today, you see they have about close to 7,000 commercial banks and probably more than 1,000 saving and loan associations. And also to kind of factor in the case of US, as you have already discussed and clarified, that they are also having so-called mutual saving banks. These are mainly unit trust based arrangements, and also credit unions. And these close to about 8,000 in numbers in recent times. But the question generally people would pose when it comes to US banking is the American banking system more competitive and therefore more economically efficient than other countries? So this is what people would pose. There are arguments for and against, and there are many arguments in terms of the efficiency of banking system across different countries in the world. But from a very narrow perspective, you can conclude that US banking system is competitive because they have more or less competing other avenues of intermediation, either direct financing arrangements, which are reasonably competitive in comparison to other OECD countries, and against developing and emerging market economies. But if you look at the size of US banks based on early 2010s information, you probably see when it comes to big banks, which about 7% of total number, which comprised of more than $1 billion in size, $1 billion, right? So $1 billion in size, some are many billions, bigger than often the countries that you probably see in the developing and emerging markets, simply because the GDP of most of those countries that we are referring here are not big as the banks in US. But then you look at the numbers of bigger share of banks in US, you see the size of these banks are between 100 million to $1 billion. So that takes more than half of the US banking sector. But what is important here is the role that these banks plays in US economy. That's what our concentration is, right? So irrespective of whether the size or the magnitude, what and how these banks contribute to US economy and subsequent objectives of financial intermediation is what we are looking at. So you will see the historical development of the banking system in US, where you probably see in the case of US, the more formal banking arrangements are more recent in comparison to UK. So the Bank of North America, chartered in 1782, it's almost like the end of the 17th century, and it's almost at the close of 17th century and beginning of 18th century in the case of US North American banking arrangements, which were chartered in 1782. And of course, when they were chartering this, there were a lot of controversies in the banking sector in US on the basis of how to draw the line between different states, and then of course having a one size fits all kind of policy arrangements. But interestingly, US National Bank Act of 1863, right, it is more recent in that sense, creates a new banking system of federally chartered. So you had US national banks, which are to great extent distribute across different states in US, because it's a federal setup in US, and that requires the original charter to be expanded to National Bank Act to facilitate federally. It's not restricted to different states in US. You probably see Washington is one state, okay, like then New York, but it's across these borders the federal banks operate. So at the same time, the Act introduces the so-called Office of the Comptroller of Currency. That's an independent bureau within the US Department of Treasury. That is basically the finance ministry in most of the time in other countries, or general treasury in countries like us. Okay, so this Comptroller of Currency is an independent bureau within the US Department of Treasury that was established by the National Bank Act of 1863. And this was established to serve to charter, regulate, and supervise all national banks. National banks means that banks crisscross the different states in US, and thrift institution. Thrift is saving. So saving institutions and federal branches and agencies of foreign banks. So the National Bank Act created the Office of Comptroller of Currency to facilitate not only the federally established banks in US, but also operation of branches and agencies of foreign banks in US. Okay, so at the same time, the National Bank Act in US recognized the so-called dual banking system. Okay, so the dual banking system refers to parallel state and federal banking arrangements existed in US. So the certain financial intermediaries were restricted to states. So we don't have different states in Sri Lanka to compare, but you can see it like in certain provinces. But when it comes to national banks, it crisscrosses different provinces to kind of get a close example of Sri Lanka's case. But what you are simply seeing is this federal banking arrangement and state banking arrangement coexisted in the case of US, and the US central bank was established very, very recently from the experience of other central banks in the world. The Federal Reserve System is the US central banking system, which was created in 1913. Right? So this is prior to the First World War in that sense. They have created the Federal Reserve System in US. So you see the more recent nature of financial intermediation, formal financial intermediation expanding in US in comparison to some of the countries in Europe, particularly the UK. And this could be linked with how the global economic power shifting, economic base is shifting from Europe to US in early 1900s. So that is also partly contributed to fast expansion and faster the competitiveness that we are simply seeing in US banks to some extent in a modern financial intermediation sense. So you see this timeline of US banking, commercial banking in US being looked at. You already know the chartering of Bank of North America in 1782, like. So then you looked at more recent developments in the form of National Bank of 1863, National Bank Act of 1863, and then Federal Reserve, creation of central bank in US in 1913. But in the interim, there was some evolution from 1782 to creation of central bank in US in the form of different banks being chartered across the Bank of United States. Then, of course, Second Bank of the United States also being chartered. And then, of course, during Andrew Jackson's times, Second Bank of the United States also been ceases to operate. Okay, so simply kind of see the gradual evolution to the National Bank Act of 1863, and then of course 1913's Federal Reserve Act, and then again in 1933 after the First World War, during interwar period between first and second, you see, and after the Great Depression of 1929 in US. The Banking Act, including Glass-Steagall, that's kind of bringing in so-called FDIC, Federal Deposit Insurance Arrangement, where to kind of minimize the distrust among general public with respect to financial intermediation. So when you see a FDIC, that's a deposit insurance. So that encourages people to make use of financial intermediation services rather than distrust generated across majority of general public during the period of Great Depression, where large number of banks collapsed in US, and then they were worried about whatever savings that they have with the banking and broader sense in financial intermediation. But the FDIC established more confidence among general public and bring back the markets to kind of get the services of financial intermediation in a bigger sense with the FDIC introduction and the Banking Act changes introduced in 1930. So this is how the kind of a timeline, historical timeline of commercial banking evolution that you are seeing in US, but you can link this to great extent to kind of answer the question that you raised at the very initial stages of today's discussion, where the argument was whether the US banks are much more efficient and competitive than banks in other parts of the world. But it's not necessarily to kind of say that yes, US is competitive. No, it's other countries also competitive. What you are simply seeing is their evolution is more competitive based. So they let markets to understand the market dynamics, where in the event the banks were not managed properly, the market itself punished those banks in the form of collapses that you have seen across different time periods. But interestingly, you see the banking system had really suffered during the period of Great Depression, where the people lost confidence and started pulling out all their assets that was kept with the banking or the financial intermediation. But with the introduction of more market-friendly deposit insurance arrangements, of course, you increase the moral hazard as we were discussing, but would facilitate it, bringing back market confidence in the financial intermediation system. So you see the evolution in US case in comparison to other European countries, particularly the UK that we discussed. Okay. Then, of course, we look at the prime role, the supervisory function, if not the responsibility of supervisory agencies in the banking, if not financial intermediation. So we will get going on the basis of looking at the role of regulation here. The primary supervisory responsibility of bank regulating agencies. So we will get into this with greater details. Right. So you see the Federal Reserve, that's the central bank of US, and state banking authorities. There are other agencies also acted in regulating some of the state banks, because I said US had dual banking system in operation, state and national. So national is federal level banks. So you see some state agencies also acted in supervisory or regulatory role. So the central bank, Federal Reserve, and the state banking authorities, state banks that are members of the Federal Reserve System, basically looked at supervision from the perspective of the US Federal Reserve itself, where some banks were not members of Federal Reserve System. So they were basically looked after by the state banking authorities. Okay. And also in US case, Federal Reserve regulates and supervises to some extent bank holding companies in terms of their operation. Then you see FDIC, okay, Federal Deposit Insurance Corporation, insured state banks that are not Fed members, because Fed members had many lender of last resort and other facilities from Fed coming into the financial intermediaries. But then the state banks, they are not Fed members, as I was mentioning a little while ago. FDIC had more or less insured those agencies' deposits to give confidence to the market and to the general public. So the state banking authorities mainly acted state banks without FDIC insurance. So even state banks who are not members of Fed, not members of FDIC, had some regulatory oversight from a state banking authority. So this is how the system was in place in the case of US. Okay. Then, of course, you see in recent times so-called financial innovation and the so-called growth of shadow banking system. Also important to kind of see when we are going forward in determining the regulatory role of recent central banking and financial supervisory agencies. Okay, so the financial innovation, as you all will know, is part of the desire to earn profits. So how financial innovation evolved is mainly because the search for profit by financial intermediaries. When they see the opportunities for profits is drying down, they probably move into avenues where they could make higher profits. And the financial innovation would be the outcome in such circumstances. But financial innovation that improves the competitiveness of the financial intermediation and bringing in solution to problems of investors as well as general public in financial markets. But interestingly, that has to go in collaboration with risk-taking and a level of profits, but it should not be only guided by desire to earn profits. A change in the financial environment in recent times, you probably see stimulated the search by these agencies, financial intermediaries, for innovation that more in favor of making higher profits. So that's exactly what, to some extent, happened during the great financial crisis that we discussed in our previous lectures in 2008 and 9 periods across the OECD countries, and at the same time it spill over to developing and emerging market economies. And then you see the concepts of financial innovation, where we will looking at financial engineering per se, and also shadow banking. So when it comes to financial engineering, as we highlighted in one of our previous discussions also, what we were trying to explain at that time was to say that the engineering in the financial field was partly because the emergence of many models, mathematical techniques, and many models, and which are to some extent computer models into their sense, which have been brought in to solve financial problems, right? So financial engineering uses tools and knowledge from various fields in the form of computer science, statistics, economics, as well as applied mathematics to address more or less recent financial issues, as well as to devise new and innovative financial products based on financial market requirements, risk mitigation, diversification of investments, and to see opportunities created through creating special purpose vehicle SPVs. They look at these so-called financial engineering with the knowledge extracted from other fields of interest. And the other fields of interest often work in the form of a more concrete pure science environments. But in the case of markets and economics and what you are simply seeing in financial market, you probably be exposed to dynamics of human behavior and also uncertainty, where you cannot kind of control the environments and behavior of people. And of course, that leads to so-called volatilities that emanates from economic circumstances. So the financial engineering helped to solve some of these problems, but at the same time created complex financial products, which also kind of a blame for financial crisis in recent times. And when you say shadow banking, you see this is the financial intermediary's role. Here, the financial intermediary is involved in facilitating the creation of credit across global financial system. It's not necessarily restricted to the boundaries, your locality, but you are expanding yourself across states in the case of US and across the globe, kind of crisscrossing other sovereigns, that means other countries, but whose members are not subjected to regulatory oversight. So to some extent, shadow banking is you try to introduce banking activities which do not fall into regulatory purview. Okay, so the banking activities that you are simply seeing is regulated across the world, but when it comes to shadow banking activities, it's been very much that you try to introduce activities which do not fall into regulation, that crisscrosses across different financial systems, and then of course they are not subject to regulatory oversight. So the shadow banking system also expanded sharply prior to the financial crisis that we discussed in our recent classroom discussion. So you see the kind of innovation, evolution of financial intermediation into more recent complex financial products through engineering and then of course circumventing regulation in the form of shadow banking. So you are basically circumventing, you are not fall into the regulators' regulation, and try to kind of overcome that by introducing banking activities which are not in the regulators' eyes, if not regulators' purview. So you see this changes that we are now seeing. I'm not kind of discuss the greater details of evolution of financial intermediation as such, but I just highlighted UK and then US, and then gradually moving into the evolution of banking system in terms of changes to demand conditions. That's what important for us in today's context, right? So when you see the changes in financial intermediation in today's context, you see the market circumstances change. That's what I said when it comes to more of social sciences that we are now familiar with and studying in the form of economics and financial markets, where you see you cannot apply pure laboratory environments. It changes with dynamic circumstances that we are exposed to. And then the markets also has to respond. Financial intermediation also has to respond. So the financial intermediation has responded to changes in demand condition. So the demand conditions, particularly the interest rate conditions, interest rates volatility. Interest rates are not static, not one number for all the time. Interest rates move up, move down, and sometimes kind of behave unpredictably, and this creates a lot of circumstances in which the investors burn their fingers or make windfall gains, right? So you see the volatilities across interest rates, and then this requires financial intermediation, financial intermediaries, or the banking industry to respond. So how banking industry responded for interest rates volatility, that's what we are trying to read and understand from this section here. Okay, so you see here, first and foremost, with the changes in interest rates, the more concrete products of financial intermediaries, for instance, let's say mortgages, which become not fixed mortgages, but more or less adjustable mortgages, adjustable rate instead of fixed rate. You see adjustable rate mortgages. Okay, so you see now, instead of fixed rate products, financial products, you see floating rate products are getting into the financial markets, and people are demanding such products because they can ride the volatilities in interest rates. Okay. So you see here adjustable rate mortgages. So flexible interest rates, okay, that makes the investors to make profit when the interest rates increases. If you are fixed, you are getting the fixed levels. But when it comes to flexible rates, when the interest rates increases, your return also increases. So you are linking your products in line with the adjustments in interest rate structure, because interest rate structures are very dynamic. It's not static as one number for all the time. So it changes every second across financial markets now, and generally it changes within very narrow bands when the financial markets become efficient. But at the same time, there may be policy induced, if not sudden market response for events of magnitude. These are events which are big magnitude, which has impacts across the bigger macro picture, bigger macroeconomy, and sometimes across different countries, different regions, and at times globally, like what you are now seeing in terms of COVID environment. So these adjustable rate let individuals, if not investors, to ride across volatilities in interest rates. And then, of course, when it comes to adjustable rate products in the form of mortgages, when you introduce mortgages to attract customers, lower initial rates, right, makes them attractive to kind of a fixed asset buyers, like home mortgages. So you introduce these financial products because of the changes that you are seeing in demand conditions in the market with lower initial interest rates. So when you see low initial interest rates, you get motivated, attracted to fulfill your dream. I mean, in US, you see the house, own home is a dream of general public. So they see that they get attracted for such possibilities and opportunities when the interest rates are flexible, and initially that lower interest rates make them attractive to get them into the financial market and engaging in financial market products. So you see the demand-based introduction of mortgages coming with adjustable rates in US and in other markets, and also now it's like a norm in today's context across different countries. Then you see derivatives, financial derivative products. Okay, so when you say derivatives, derivative is a security with a price that is dependent upon or derived from one or more underlying assets. The financial derivatives get its value and its pricing based on some underlying assets. So there are certain assets being pledged or linked to derivative financial instruments. Its value depends on how the underlying assets behave. Okay, so in the financial markets, these underlying assets varies from risk-free government papers to very much risk-based products, including junk bonds that you might see based on our credit rating discussions that we discussed in our past lectures. So you see these derivatives itself is a contractual obligation between two or more parties based upon the assets that you've been keeping as underlying for this derivative transaction. Its value is determined by fluctuation in underlying assets values. So you see this facilitate ability to hedge interest rates volatility. So if you have underlying assets which act as a buffer to interest rates movements, so that hedge your interest rate risk, simply because when the interest rate risk is high, the underlying assets price or the value also increases. So that would act as a buffer for you to protect yourself from volatilities in interest rates. Okay, then of course you also have payoffs in financial derivatives are linked to previously issued securities. That is, that payoffs in the derivative products are linked to underlying assets and it's derived from underlying assets. So you see sometimes the derivative products requires you to bring in a value at different times based on the prices of the underlying assets. Sometimes even the possibility that your values have gone up, even the intermediary might release part of your assets because the prices have already increased based on market conditions. So that gives you expanding your investment, or at the same time you can release part of the investments that you have already locked to other financial investments possibilities. So the response to demand conditions, changes in demand conditions, you see financial derivatives have now come into the market, come into the picture. Adjustable rate instruments, flexible rate instruments have come into the picture. For instance, even in Sri Lanka, you see flexible rate investments. You will see at the same time as the demand conditions changes, not only you issue instruments in your domestic currency, you also issue instruments in highly liquid foreign currencies. In Sri Lanka's case, we have US dollar denominated Sri Lanka development bonds, SLDBs, right? So these instruments being issued because market is demanding, market demand conditions are changing. Sri Lanka has remittances, people who invest in other countries based on their foreign currency earnings are now attracted to invest in a home-based, locally issued product, that is Sri Lanka development bonds denominated in US dollar. And also that provides you the option both fixed rate and floating rate. Floating rate at times linked to a benchmark. In the case of SLDBs, it's been linked to the LIBOR, London Interbank Offered Rate, 6 months LIBOR. So these details are again available in the central bank websites. You can go to the central bank website, look into some of these details, and you can kind of get a feel on how the financial products have been defined in today's context. So this is how the changes now shaping up. Adjustable rates, that is flexible rates, then of course derivative instruments, and then of course you see not only linked to the domestic currency, but you're expanding opportunities for investments in foreign currencies, liquid foreign currencies, and also provides with the choosing of a flexible option versus fixed rate options, as in the case of SLDBs. And also, you see demand conditions is one side of the equation, supply conditions, right? So you see the efficiency of the industry is vastly changing. Now the circumstance is changing again with the COVID environment. So you have to bring in so-called health guidelines as new normal in today's context, given the COVID threats, COVID challenges the world is exposed to, right? So the supply circumstances of the financial intermediaries also changes. People are increasingly using online banking, right, in place of physical banking that was the norm some time back. Okay, so you see you are expanding into more of non-physical but electronic banking circumstances. And then of course your payments also not necessarily in the form of coins or currencies now, but more or less your payments are in the form of credit and debit cards in today's country. So what it's again facilitates is it also provides you with more accurate record keeping, and at the same time management of your bank balances. But at the same time it also promotes now the safe and secured environment under health related guidelines. But at the same time you also see in today's context you can top up balances in your promotion cards or promotional arrangements the suppliers provide. Suppliers again links with financial intermediaries often for this type of products, where even the small changes you not necessarily carry with you. Small changes get accumulated in your accounts, and then that can be cashed at one go with possibly promotional arrangements also. So you see the supply circumstances changes. So the credit cards, debit cards, that's become much more of today's everybody's life, and improved computer ICT backgrounds are facilitating this development, and also helps to reduce so-called transaction costs. Of course, initially you need some investments, but overall transaction cost reduces when you move into more of credit debit card transactions. Then of course you see electronic banking. Normally you don't now visit banks to withdraw smaller sums of withdrawals. You basically look at ATMs, and now it's going beyond ATMs. You go to home banking and also virtual banking kind of arrangement. You don't need to physically look at. Then of course supply conditions also warrants investors to take investments decisions on the basis of risk return characteristics. Junk bonds are very low in terms of credit worthiness. That means risk is very high. So the investors might require a high return. So the markets facilitating supplying junk bonds, and then of course investors are happy that these junk bonds are providing high returns. Of course, they have to take the risk in comparison to high credit worthy bonds where the returns would be lower. Okay, so then you see commercial paper, CP market. That is again in a way when the goldsmiths initially in UK, in place of deposits issued a paper or a note, and these notes started trading. It's a kind of a more advanced circumstances in the form of commercial paper. You can actually link up receivables, payables, and then bring into the contractual arrangements and then trade these papers in the financial market. You can discount them in the financial markets, and this is expanding with changes in supply condition in today's context. So you see demand conditions warranted changes. Now supply conditions warrants the changes in financial intermediaries and the financial products that you are familiar with. Okay. Right. So then you see the supply conditions also warranted introducing so-called securitization products. So you discussed all these CDOs and things in our financial crisis discussion. So that itself gives you a feel that the financial markets are requiring changes in the products that they are working with. So securitization is one of the outcomes. So the securitization is the process of taking an illiquid assets. You see liquid and illiquid assets are available, okay, or group of assets, not a kind of a single assets that you keep, but you take a group of assets, and which again contributes to diversifying the assets characteristics. And through financial engineering that we see with modern facilitation to other fields of knowledge, so-called financial engineering, transforming these assets that we looked at into a security, CDO, that the collateral-based arrangements that we discussed across financial crisis discussion. That is the very simple example of a securitized product. So what you are simply seeing here is you take different liquidity groups into one product. You transform them into a single security, because you see some are liquid, some are illiquid, but when you transform all into a different financial product, you can avoid illiquid assets impact into that the pooled assets that you are looking at. And now also you look at different type of asset classes. Some assets would be high yielding, some are low yielding, some are not necessarily kind of linked with interest rates that acts as buffers. So you can kind of create a financial product, transform them into a security, and thereby manage your risk. But any excessive securitization efforts is challenging, but now the regulation has put them into perspective by bringing in so-called capital adequacy requirements. You have to have different capital levels if you are taking excessive risk. So that's the kind of a way in which financial markets intermediation change with expanding financial engineering, and then of course information technology circumstances to bring in transformation into the financial assets that we are familiar with. So the securitizations helps to transform otherwise illiquid financial assets into marketable capital market securities. So nobody will prefer illiquid ones. Illiquid ones are very difficult to transact in the market. So the securitization helps this illiquid assets to become liquid and also market in capital markets. And also securitization played a especially prominent role in the development of a subprime mortgage market. You saw that in all our discussions because that's over securitized and over expanded to the extent where you are not in a position to kind of figure it out. What's the underlying assets? What's the underlying security in the case of subprime mortgage related considerations in 2000s across subprime period. So you see the changes in supply circumstances, demand circumstances, and financial markets are evolving. Okay. So then at the same time, the financial markets regulations also looked at from avoidance of existing regulations, because there are ways through the regulations being circumvented, and shadow banking is one of them that we discussed. So avoidance of existing regulation is in a way called as loophole mining. So you look at loopholes in existing regulations and try to kind of figure it out, ways and means through which you do not fall into regulations. Okay, so this so-called avoidance of existing regulation also become part of competition for profits, and the banks or financial intermediaries look for ways to skirt regulation, circumvent regulation, and this is known as loophole mining. Please remember, this is nothing that you try to kind of avoid not falling into regulation, but you see within the regulation whether you have opportunities not fall into this regulatory consideration, and you try to kind of manage within the regulation itself and try to kind of enhance your profit opportunities. Okay, so you see in regulation, so-called reserve requirements are there. So when you have a deposit, you require to kind of maintain certain percentage of that deposits with the central banks as a statutory reserve requirement. In Sri Lanka's case, now statutory reserve requirement is only 2%. Okay, so if you have 100 rupees of deposits, only 2 rupees you have to keep with the central bank as a statutory reserve. So the reserve requirement invariably act as a tax on deposits, because that 2 rupees that you keep with the central bank do not work for you. If you are a banker, you see that 2 rupees you kept with the central bank do not give you a return, because most of the reserves are unremunerated, do not pay your interest income or any other income. But there are circumstances, remunerated reserve arrangements also available. So if you see a remunerated reserve arrangement, even if you keep a certain reserve with the central bank, that reserve work for you, because that earns for you. So you don't necessarily worry that your reserve that you kept would not be bringing in an income for your circumstances. But unremunerated, that's the normal circumstance across regulation. You do not necessarily get any return. So the balance portion that you have with you is the resource that you have to kind of make use to make returns and income. So the banks would see this reserve as a tax on their deposits, but effectively it's a tax on depositors, because depositors would not necessarily be getting this return, because that you have to keep that portion, and the banks do not part that return to the investors. So you see that arrangement across different period, but because of this, loophole mining also becomes quite famous, because banks try to avoid directly deposit taking to skirt this reserve requirement, and they promote other type of products. They probably promote investments in debentures. They issue debentures, that's bonds, corporate bonds. Okay, so the corporate bonds being invested by investors, then there's no reserve requirement for such investments. Okay, then you see another way of skirting regulation is there may be restriction on interest paid on deposits. Okay, so you see restriction in interest paid on deposits is to make that investors and financial intermediaries appropriately define the risk return characteristics. So markets might see, the financial intermediaries might see that they are going to pay very high level of interest rates. So high level of interest rates means invariably the financial intermediaries have to lend in the form of highly risky projects. So that means you are exposing the deposits or the investments by market participants into risky avenues. So this is more or less you are promoting the possibilities of adverse selection, right? So when you see adverse selection, there are related problems being discussed in our previous lectures. So adverse selection, and then of course moral hazard possibilities would create the confidence among market participants about the financial intermediaries, and thereby disintermediation get promoted. So the regulators might bring in certain caps in interest rates that you must be paying to certain type of deposits, and even the certain type of financial products that they are introducing, regulators might bring in caps on interest that they can charge. For instance, credit card interest rates. Now also you see, due to COVID related economic volatilities, the regulators are also expanding and governments are also expanding so-called facilitation in the form of low interest rate liquidity supports, working capital supports, and different lending schemes, which is quite popular across different countries at this moment of time, even in Sri Lanka, right? So you see the products are fastly getting popular across different circumstances, and these products being introduced, and regulators introduce such arrangements to facilitate a further expansion of financial markets. But then of course the banks and the financial intermediaries try to avoid these regulations through loophole mining, and try to kind of facilitate higher payment of interest through various other schemes. Okay, even you might have chances of foreign travel, but now foreign travel also not possible given the restrictions on COVID related health considerations, but maybe other schemes, facilitation of the luxury goods, various type of home appliances, all possible. Okay, so then you see money market mutual funds. Money market mutual funds are short-term financial market products. So money market is a short-term market. So the market are trying to kind of play based on the regulators' requirements to maintain liquid assets portfolios, and also try to facilitate through the open market operations that the banks, the central banks introduced to maintain orderliness in the financial market. And they worked with possibilities of short-term market volatilities to benefit in their investment decision and things like this. Then you see sweep accounts. Sweep accounts are not necessarily like lottery accounts, but these are the accounts that could be used to kind of manage volatilities, if not the movements in financial assets market valuations. Okay, so could be one form of buffer the market participants could use to avoid possible the regulatory actions on financial intermediaries. Then of course the financial innovation also contributed to reduce or decline of traditional banking. Traditional banking is nothing but you take deposits and then you lend. So your basic banking function is deposits taking and lending out, and then you keep a margin, and that margin is the profit. So this is the conventional, if not traditional, banking activities. But then of course financial innovation comes in and play a role. There the financial innovation push the banks going beyond the traditional or conventional banking efforts, and the banking has evolved to the extent of fee-based activities. The fee-based activities are now become, or investment-based, return-based activities have now become more or less the main activities in some markets, some banks, and some financial intermediaries, in comparison to pure reliance on traditional banking activities. Okay. Then the explanation here is the conventional banking or the traditional banking has reduced in terms of market share, and also for borrowers, they are not necessarily borrowing directly from financial intermediaries, that is indirect finance. Of course, indirect finance is still big, but its share is reducing. They are also looking at opportunities for direct finances. Okay, and financial innovations have given them opportunities to access different resource bases in the financial markets, and thereby facilitating their requirements for additional funds, additional resources for the expansion and other type of purposes. And also commercial banks' share of total financial intermediary assets, the traditional banking related assets, have declined in recent times. Okay, but this does not mean that the decline in traditional banking has contributed to decline in overall profitability in banking, if not financial intermediation. Financial intermediation continue to have higher profits and continue to maintain their profitability under the circumstances where the movements from traditional banking to more of recent financial innovation based income that they generate. Okay, and then of course off balance sheet activities based income also increased in financial markets in recent times, and this is also partly attributing to shadow banking related activities that we discussed in some of our previous discussions. Then you see the bank's share of total non-financial borrowing, the commercial banks and thrift saving institution, and you see percentage of total credit and advances of commercial banks not necessarily decline much. Of course, in absolute value, you probably see these were maintained at sizable levels, but then of course some moderate decline in recent times. But the saving agency, saving institution, thrift's share has declined substantially in recent times in comparison to the 60s, 70s, and 80s possibly that you are seeing here, and the bank's share of total non-financial borrowing by the market participants from saving institutions have reduced, whereas from commercial banks it seems maintained at a reasonable level, 1/4 like or slightly variation from 1/4 levels in different times, including more recent periods from US financial market circumstances. Okay, so it's not possible to kind of put direct questions to me like you send some clarifications through the chat mode in our regular discussions, but here you can take down if you have any questions, and you can follow it up in our future classes, future discussions. So you see the financial innovation and decline in traditional banking activities also has declining cost advantages in acquiring new funds. Deposits are liabilities of financial intermediaries. So you are seeing there's some decline in cost advantages in acquiring funds in recent time. Okay, so the linkages in inflation to cost of financing, if not interest rates determination, also contributed to this, because you see when the interest rates are increasing, you probably link that with increasing inflation circumstances. That's what the Fisher equation that we discussed some time back, which explains that the inflation has a link in nominal interest rates that you are looking at. So you see rise in inflation led to rise in interest rates, and when the interest rates are increasing, people tend to kind of move out from conventional, traditional banking activities to other possible sources of financing. So you see some disintermediation, but that also related to confidence in financial intermediation. The confidence has been facilitated through FDIC kind of arrangement. Okay, so low cost source of funds become popular. Checkable deposits, time deposits. Okay, you see checkable deposits are savings basically, not fixed deposits. Fixed deposits, you see, you cannot withdraw for a given duration, but still you can withdraw within that duration. But then the rate application, if not interest rates arrangement, varies substantially from fixed deposits to a normal checkable deposits. Okay, but these were reducing in importance in recent times in terms of liabilities in financial intermediary books, and the share of this is still prominent, but some reduction is noted across financial intermediaries, particularly in advanced economies in recent times. Okay, and also financial innovation contributed to decline in income advantage on use of funds. Okay, assets. Okay, the asset side of a financial intermediary's book is loans. Okay, liability side of a financial intermediary's book is savings. So that's what we discussed in the form of financial innovation has contributed to decline in traditional the deposit taking role in the form of declining cost advantages in using financial intermediation in recent times. Similarly, the asset sides, the loan sides, also has declining income advantages on use of funds because of financial innovation. So mainly the reason is the ICT, information technology, has decreased need for banks to finance short-term credit needs or to issue loans. So facilitated more dynamic treasury management arrangements through information technology arrangements, and also pooling different branch networks to see whether the banks has more or less well-managed resource bases. So if not, what happen is, if you do not have linked up banking arrangements, you probably see your one branch is short, but the next branch is surplus. But unfortunately, because you are not acting as a cohesive, collaborative, interlinked system through ICT-based arrangements, you probably come to know that with a lag. Okay, so you probably not necessarily benefiting from ICT-based opportunities in the financial markets, in the financial intermediation, but you go to kind of a burrow, and thereby creating unnecessary demand on the part of your financial intermediary itself on the financial market, and thereby your cost increases. But you should have easily managed if you have linked up from the excesses available within your group itself. Okay, so you see the loaning possibilities across different arms of your intermediary or different branches of your intermediary, facilitated through information technology. And also information technology has lowered transaction cost for other financial institutions, and that has increased competition, and across the financial market everybody benefited, right? So financial intermediaries are well aware the different rate structures available for financial market participants, and the stakeholders would definitely shop around. That ICT has contributed this facility for the market participants, and market participants actually benefiting through increased competition, and the banks also requires to compete against their other competitors by providing efficient, low, and much more secured financial opportunities for the stakeholders. So you see the decline in traditional banking activities through financial innovation is a positive, and these positives have both liability side repercussions, asset side repercussions. And similarly, we discussed the arrangements of traditional banking has evolved in recent times, but their profitabilities have not necessarily shifted much. Okay. So you see these changes that are happening across financial intermediaries, financial market, the banking industry. So how the banks, financial intermediaries responded? Demand side responses, supply side responders. Okay. So they have done so, but still there are other areas of responses these banks have moved into. So we'll look into some of those stuff in this slide and in few more slides as we move on. Okay. So you see here, the bank started kind of expanding into new and riskier areas of lending, right? So they are not necessarily now restricting themselves into certain risk levels, because you already recognize the fact that they have to kind of leverage in their portfolios to benefit from possible earning opportunities. So they move into new areas, and possibly some of them are riskier. The kind of adverse selection related possibilities also there, but they have to move into these areas in order to manage their overall portfolio and the profitability to great extent. But then the regulators would look at these from a perspective of defining what's the capital base that they have to maintain, whether it's a risk-based arrangement or a fixed volume-based, all kind of possible, and we discussed to some extent. So banks have started kind of moving to risky and new areas of lending, and this is the assets in a bank or the financial intermediaries books. Okay, so the areas are often real estates, commercial real estates. Now you probably see all these the condominiums and real estate assets that we are seeing across is a new area where you see a reasonable return when you are in a booming stage, right? And it's a matter that whether the real estate sector is continue to have that opportunity in terms of growth need to be closely and seriously evaluated, because the examples of the bubbles that we discussed would create much more risk possibilities if these bubbles burst. So the regulators are mindful, but banks also mindful of these things, and at the same time they are mindful of exposing to some extent in terms of their return expectations. And then of course they also look at riskier and new areas of lending in the form of takeovers and leverage buyouts. So they are not necessarily look at the opportunities in terms of smaller or small assets investments, but possibly big takeovers and buyouts through which they could create a reasonable market share. But of course, the regulators also mindful of these things, and they also keep an eye on. So they maintain so-called single ownership limits within the group or the assets holding, what levels of assets, what maximum capacities of assets can be maintained, all being looked at. Okay, so banks also look at off-balance sheet activities. This is non-interest income based, fee based. Okay, and also This is also looked at in the form of concerns about new risk opportunities, which brings in higher income to the banking and financial intermediary sector. So these are the areas that banks started responding in. Okay, but at the same time, the bank consolidation and nationwide banking also evolved. And you already seen the consolidation that we discussed in our previous lectures contributed to further the problem of too big to fail. Okay, you are now creating bigger financial intermediation, and the repercussion of such bigger financial intermediation is economy-wide impacts if they do not manage and conduct their financial intermediary role. So the regulators are mindful of these, but at the same time, two smaller entities are now being promoted to consolidate. That's to compete and also to make sure a transaction cost benefits being acquired. So the nationwide banking is also one way of looking at in the US case, instead of state only restricted to particular state kind banking or financial intermediary activities. Okay, so the number of institutions that you can count and call has declined in recent times across US as well as in other countries. Okay, so partly this is because bank consolidation, because bank failures, there are kind of movements and regulatory actions to consolidate smaller ones with reasonably established financial intermediary, if not few smaller ones being pooled and consolidated into a reasonable size financial intermediary. Then of course some deregulation, which also enhance some possibilities that these banks could consolidate themselves, so thereby increasing the possibilities of competitiveness. Okay, so then of course information technology advancements, which facilitated consolidation not only across the same bank or smaller banks, but at the same time establishing certain platforms, for instance, payment platforms. You don't need to have your own payment platform. You can become a member of an existing platform, thereby you can perform the payment platform function at a much cheaper cost than providing it on your own. This is a scale benefit. So if you have a capacity, you have a settlement initiative, you have a payment gateways, you have the branching arrangements, you can work through much more efficient arrangements in the form of information technology facilitation, and also this facilitates so-called scale benefits to the entire financial markets. And also results now you are seeing in smaller number of banks in aggregate from the bigger numbers that you have seen in the past, but the assets that they hold has moved into a larger bank, so which has become bigger in size. And that also one facility, because you see, when you do not have a reasonable asset size, for instance, when you see an opportunity to go out and make sure that you are accessing opportunities in other markets like offshore banking and things like that, you look much more smarter and you look much more productive in the eyes of investors in other countries when your size is big and you have a reasonably big asset portfolio. But if you are very small, they probably look at not even worth for spending time to evaluate your bank's possibilities. So you see, the consolidation and nationwide banking provided opportunities in this essence to the financial intermediation and the banking industry. And then say consolidation has pros and cons. So the benefits of consolidation is very important in today's context, and in Sri Lanka too. Today, the consolidation is to some extent promoted simply because you see leasing and finance related businesses are having difficulties in micro level operations and individual based operations. So there are benefits in the form of getting them to consolidate and work as a big consolidated institutional arrangement. So you see this possibility. The benefits of consolidation is that competition, as we were discussing all throughout, and then of course driving so-called inefficient banks to close down their businesses. If not, they require to kind of consolidate. So inefficiency in financial intermediation would be not necessarily good for the stakeholders, and at the same time you naturally kind of drive yourself into a obsolescence if you do not become efficient in a financial intermediary like in industry. So the benefits are mainly competition based, and then of course would have bigger efficiency gains to the overall economy in the form of economies of scale and scope, because the countries are competing for resources. Countries are competing for efficient resources, because the efficient resource augmentation would facilitate these countries to move out from their boundaries to new markets. So new markets requires benefits, price benefits, so you can compete. So if your cost is already high, you are moving out already with a disadvantage. But if you have increased efficiency in the entire financial intermediation, so you see you are in a better wicket to kind of go and get benefits when you move out from your foreshores, because markets are small, markets are expanding, so you require to benefit if you really wanted to benefit in possible growth opportunities. Okay, so when you see the consolidation, the probability of bank failures also becomes lower. Okay, so you see your portfolio is diversified. You are not putting all eggs in one basket, right? So you are seeing your portfolio is diversified, portfolio is kind of invested across different investable sources. So then you see the benefits there in the market itself. So this facilitate the overall the probability in the form of reducing overall probability that you will have higher risk when the markets turn bearish, right? So you try to kind of float yourself much more strongly when you are diversified, and these are the benefits the consolidation brings in. But then of course the cost in the consolidation also need not be ignored. So the consolidation would basically take out a small community base, if not a lower strata of economic agents whose access to certain type of community banking, if not financial intermediation, would be taken out of the equation. Okay, so the bigger banks also would not encourage to lend to small businesses. So that requires then separate attention from other policy authorities, right? So the costs are the elements here that you see much more targeted. Small timers would not get access to the kind of financial intermediary facilitation when banks started becoming consolidated and becoming big in a consolidation environment. Okay, then of course moving into new areas, consolidation would facilitate them to move into new areas and taking increased risk would also expose banks to kind of, fail if markets completely reverse against you, right? So such circumstances also could not be discounted out. But ultimately, what you are simply seeing is the benefits outweigh the costs, and to great extent, which supports that consolidation is a much more beneficial, in a sense that the countries, not only in OECD, if not advanced economies, but also in emerging and developing economies, in today's context, favor. And this is not only for the banking industry, but you also see other financial intermediation in the form of leasing, finance, and then of course thrift and a mutual fund arrangements like what we were discussing in US in recent years, right? So the number of insured banks in US in numbers, that's what you are seeing here. So the number of insured banks have to some extent reduced in numbers. This is exactly what we were trying to say, that some consolidation in recent years have reduced the numbers in advanced economies, and they see that has contributed to diversify their asset bases and asset portfolios, and these numbers again facilitate supports that consolidation has made banks to be more efficient and contributing to overall scale and scope benefits for the economies. And then you see the separation of banking and other financial services industries throughout the world has now become much more challenging. You cannot separate banking and other financial services from the outset, because most of the financial intermediation provide most of the services now being asked. So the universal banking kind of arrangement, but universal banking in a sense is today your local bank. Universal banks have become your local bank kind of facilitation, because the international big banking giants, big financial intermediaries have become almost of a local bank in today's context. Okay, so universal banking is a concept that you, I believe, to some extent aware, is this financial conglomeration which combine all different banking activities that undertakes under a single roof: retail, wholesale, investment banking. Okay, and then of course benefiting from the synergies that they enjoy. These intermediaries have synergies. They have the technology. They also have customer service, and also they have the base in the form of the branch or the space. So you find this combines retail and other banking type of activities, corporate, wholesale, treasury, investment into a single arrangement, and benefits from them. Through universal banking, the notion is that they would benefit from economies of scale and scope, and particularly because of information technology advancement and access to capital. Access to capital is today not limited to your own domestic market, but you can access to capital across different markets to serve companies and retail customers, not only in your periphery, but around the world. So you see the universal banking, in the sense, has brought in a sense of scope and scale benefits, and simply this been facilitated by advancement in information technology and globalization of financial services. So you not only look at your resource augmentation, deposit or investment opportunities within your locality or the boundaries, national boundaries, but you look at it as an opportunity available. If you are competitive, you are capable by resource mobilization from outside your country, and you become a global giant. And then you are servicing also not limited and restricted to a local customers, but you are looking at opportunities across the world. Okay, so here the universal banking also facilitated no separation between banking, conventional banking kind of activities, and investment, securities industry related activities. So you might have everything under one roof. You have investment arm, you have a custodian arm, you probably have a home, if not retail banking, wholesale banking, corporate banking, all facilities in the same premises, but you are not necessarily separating them, but the controls required, firewalls required to be established. Okay, so also you might be engaged in underwriting businesses. That means you probably be establishing to facilitate direct financing opportunities for other industries, other stakeholders, with underwriting possibilities that you already have your own resource bases in the event of not fully subscribed by other market participants. You yourself contribute to subscribing in the form of the underwriting that you have arranged with the agency. So here you see separate legal boundaries being established. Okay, bank equity holding of commercial firms you do not necessarily see in underwriting arrangement, because you do not have the equity holdings in such circumstances. Okay, so you may engage in different activities, not only banking but also related other industries. So you look at here everything being performed under one roof. So you walk in, you will get everything, because you probably see you require, if you take trade finance in today's banking, so you require insurance facilitation. Even if you look at today's financial intermediation in the form of international trade and travel, you probably required insurance facilitation. Okay, travel insurance, trade insurance, right? Even if you have trade facilitation of importing goods and services, yes, you require insurance facilitation. Okay, so all being provided under the kind of a global banking concepts. So then you see some legal separation. Okay, so to make sure that legally you recognize different arms being established, sometimes for regulatory purposes, because the banking activity is being regulated by central banks, insurance related activities being regulated by insurance regulators, insurance ombudsmen, right? So you require some legal separation. Okay, so allowed to hold equity stakes in commercial firms, but holding companies you do not necessarily facilitate in such circumstances, because that would create competing interest, although it's been a different entity. The holding company is same, so you can influence through holding company the operations of the individual entity that you are looking at. So you see the financial intermediation and other financial services are hardly separate. I mean, you can't separate in today's context. So you see this is combined to the extent where facilitation in the form of scale and scope benefits is very common in today's economies, right? So then you see some thrift industry. So thrift industry is saving industry in the US case. Okay, so you can figure it out here. The Thrift and Saving Association was quite popular in US, but then of course with the financial distress, financial crisis in 2008, some reduction in the numbers and the volumes being noted. So they are moving into more formal financial intermediaries of banking in most of the advanced economies. Okay, and also these saving and loan institutions in US, and also mutual saving banks, which are mainly unit trust kind of facilitation. So you see, these were chartered saving and loan associations being chartered by federal governments in US, or at times by states, but mutual saving, majority of them being chartered by states. Okay, then of course they have their specific deposit insurance arrangement, right? So these features would not necessarily be important for you to concentrate for your exam here in Sri Lanka, but at least some understanding in the form of how these being formed and kind of structured in advanced economies is what explained here. So I will not necessarily take time to kind of explain here, but you see, apart from the saving and loan, and then of course mutual saving banks, even unions, credit unions are quite popular and quite common across advanced economies, particularly US, because they have tax benefits. Okay, and also comes under the purview of both federal and state governments, and they have specific deposit insurance arrangements, not necessarily FDIC kind of arrangements. So this is kind of, you know, some features you see. Universal banking and international banking, you cannot necessarily separate in today's context, but international banking is rapidly growing because of trade and existence of so-called multinational corporations. They are operating across different parts of the world, so it's naturally available across different countries. Okay, so global investments, where some parts of the world have excess resources, some part of the world has less resources. So international banking facilitate moving these resources at competitive, profitable opportunities. Okay, and then of course euro-dollar market. That means you are tapping your resource requirements by issuance of securities in countries outside the country of the currency of denomination that you are looking at. If it is US dollar, you are issuing US dollar assets outside US is euro dollar. Okay, so it's a euro dollar market. So the countries who require the hard foreign currency, they tap the euro dollar market to get their assets or the financing requirements in today's market. Okay, okay. Then when it comes to euro dollar market, you already know these details. Dollar denominated deposits held by banks outside the US is the main resource base. Okay, so US dollar is most widely used international currency and in international trade. So these are not necessarily subject to regulation. Offshore deposits not subject to regulations, and ultimately this source is channeled back. These assets available across the world is channeled back to US at different times, and that facilitate US to have their market interest rates maintained at a very competitive level all throughout. Okay, so these numbers that I'm just showing here is the size of banks. Okay, so in 2018, you can see 2018 S&P, Standard & Poor's Global Market Intelligence Report. Not all banks are listed here, but you can see here the top 4 banks as per 2018 S&P report are Chinese banks. Okay, the biggest Chinese bank has resources over $4 trillion. $4 trillion. Okay, Sri Lankan economy is less than 1/10 of a trillion. 1/10 of a trillion, right? So you see the size of these China's banks, because China's economic revival in recent years has facilitated all these big Chinese banks to become global giants. And the fifth is a Japanese bank, Mitsubishi UFJ. Okay, so then JP Morgan, that's a Western bank. Then HSBC, BNP Paribas, that's a French bank. Okay, so likewise, you can see these banks in aggregate assets. And Japan Post is the world's biggest saving fund, where the households invest in Japan's postal banking system, and that's been subsequently invested in global assets and also in Japanese government papers. But this same size of asset bases, if you look at in the form of 2011, here this is 2018, more recent, and in aftermath of the global financial crisis, that's in 2001, you see the Chinese banks are not necessarily the biggest. So only two in top 10, number 5 and number 8. But other banks are Europe, and then European banks are here, few European banks. But you can see what happened to these banks now. Some of them are not even here in this picture. So that itself shows how the financial intermediation has helped in the markets like China and East Asia, and thereby not only helping their economies to grow, but also make sure they also becoming prosperous and consolidated and big. So this is exactly what we were trying to say, the benefits in the form of scale and scope in driving economic opportunities for countries. So with that note, we can conclude our discussion here in today's presentation. Some of these concepts and ideas that we discussed is very important to link up with the last 2 lectures, and also helps to kind of further elaborate the discussions on financial crisis, and also in the form of concepts that we learn across a bond market, interest equilibrium determination, and things like that. So with that point, we will stop the discussion here, and we'll be able to see some of these stuff being again facilitated in our discussions in coming lectures. So you see this discussion today in recording. So if you have any clarification, we can follow up. We probably be meeting again, possibly on tomorrow is 15th. So possibly on 22nd, yes. So with that note, stay safe. Good night. Thank you.